Well, good afternoon, ladies and gentlemen, and thank you for joining us here today for another OIC-sponsored webinar presentation. My name is Ken Keating, and I'm an Associate Principal here at OCC Investor Education, as well as an Options Industry Council instructor. And I will be giving today's presentation on understanding the protective put. So before we get started, just have to do a little house cleaning. So always have to mention our disclaimer. Options do involve risks and are rather complex vehicles, so anyone looking to trade options should read and understand the characteristics and risks of standardized options, which you can get by either visiting us at optionseducation.org to download a digital copy, or you can reach out to your broker or any exchange on where options are traded to receive a physical copy. In order to simplify the calculations today, the commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. Okay, a little bit about the OIC. Who is the OIC? Well, the OIC, the Options Industry Council, we are the education arm of our parent company, the OCC. The OCC is the Options Clearing Corporation, which is the world's largest equity derivatives clearinghouse for exchange-listed options. So we started out as a cooperative in 1992 to provide education both on the risks and benefits of exchange-traded options to the public. So we do this primarily through our website, optioneducation.org. There you'll find online courses, podcasts, videos, as well as webinars like the one you're listening to today. And we do this all free of charge. There is no cost to this, and we are fully funded by the OCC, our parent company. So we're not looking to upsell you on subscriptions or courses or products. Our entire offering is free. And just know that we are not licensed advisors. So we cannot offer you advice on specific stocks, specific setups, but we can talk about options theory, options strategy, or how a corporate action may affect the value of your options, such as a merger, a split, a reverse split, a special dividend. So we do that primarily through our investor services desk, which can be reached at options@theocc.com with any of your options-related questions. So certainly make use of that service as well. All right, well, here's today's presentation outline. So we're going to be looking at why investors choose protective puts. So we're going to look at protective puts, and then we're going to look at how implied volatility can affect the value of those put premiums, as well as the implied volatility of out-of-the-money put positions. So then we'll look at some examples of the protective put, some basic examples, and then we'll get into some variations of the protective put, things you can do to structure the put so you have that protection, but it doesn't cost you as much as well. So Q&A is actually going to be conducted along the way. My colleagues Ed Modla and Mark Benzacoin are behind the scenes answering your questions in real time, so certainly make use of that feature. To answer one of the most frequently asked questions, can I view this webinar at another time? And the quick answer is yes. The link that you use to access this webinar, you'll be able to access this webinar again in the future to rewatch the material, go over the material at your convenience. And also, just so you know, you can click the Resources List tab on your menu button, and that will bring up a copy of the PDF for the presentation, so you can download that for your records and follow along as well. All right, so let's get into it, the protective put. Why a protective put? Why do investors use protective puts? Well, by itself, buying a protective put or just buying a put outright is somewhat of a speculative trade. Okay, somebody who buys a put is looking to profit on a downward move in a stock or an index. A protective put, on the other hand, is when you buy a put against a particular stock or buying puts against a portfolio as a whole, looking to establish protection or a floor price at which you can sell the shares if needed. So you can kind of view puts as type of insurance policy on a particular stock or your portfolio as a whole. So You don't have to, you can buy that. It could be a stock that's a particularly large percentage of your portfolio, or it could be your portfolio as a whole. So puts provide downside protection for an existing long position. And the beauty about a downside put or a protected put is you still get the upside potential in that stock or your portfolio. So the profit remains in the long stock position or the portfolio position. So you still get that upside exposure, but you get the downside protection. So the strike you pick, which determines your exit price or the point at which you get protection, and the difference between that strike price and your stock price can be considered your deductible. So just like you would buy auto insurance, you pay, $1,000 for your auto insurance policy at the beginning of the year, and you're fully insured throughout the year. So then let's say you get in an auto accident and you have about $10,000 worth of damage done. So your insurance company says, well, you're on the hook for the first $1,500, and then we'll pay the rest. So you pay $1,500, which is your deductible, and the $8,500 will be covered by the insurance policy. So in this case, the difference between the strike and the stock price, you can view that as your deductible. So the coverage that you determine it'll vary between investors because everybody has their own individual risk tolerances and outlooks, but you can protect a full stock position, a partial stock position, a full portfolio position, a partial portfolio position. You could hedge against a 10% downturn, a 15% downturn, 20% downturn. So you can really tailor it to how you want to establish that protection. So once again, the difference between the share price and the strike price can be considered the equivalent of a deductible. And if the shares plummet, the investor can sell those shares at the strike price that the protection was purchased. So if the shares don't go down and remain flat, the option just expires worthless, and you never have to use that insurance. So you can use the mindset as if insurance is not used. Just like if you bought auto insurance and you paid for that premium and you never got in an accident throughout the year, I think most people would be okay with that. So, it's the same idea that if insurance is not used. Now, one of the beauties of the protective put is it's kind of like a stop limit order that never sleeps. So what do I mean by that? Well, some investors will use limit orders or stop loss orders in case their stock falls, goes down and they lock in a profit. So maybe let's say you buy a stock for $50 and now it's trading $100, and you want to lock in. You don't want to give up those profits. So you set a stop limit order or a stop loss order to sell shares at 90. So what does that mean? Well, if all of a sudden when the market's open, those shares roll over and it hits 90, if it's a stop limit order, that order will be triggered, and you'll have a working limit order to sell your shares at 90. They may or may not get filled at 90. A stop loss order is the same order, but it becomes a market order. As soon as that stock hits 90, your order will become a market order, and you'll sell your shares out wherever the bid is at the time. So many investors use these type of orders, bid till cancel orders, in case the stock goes against them, and they can lock in their profits. But what happens if you're sitting on one of these stop loss orders and some news comes out over a weekend? So maybe the CFO of the company that you're invested in has been embezzling funds out of the company, and Monday morning the stock is poised to open up at 60. Well, your stop limit order to sell shares at 90 will get triggered, but you'll have a resting order at 90, and the stock will be trading 60. So that doesn't really help you. If you have a stop loss order, your limit order, your price point will get triggered at 90. You'll sell your shares out at 60 or below, wherever it's trading, wherever the bid is on Monday morning. So the beauty of a put is it's like a stop limit order that never sleeps. So when you own that put, you own the right, but not the obligation, to sell those shares at any time on or before expiration, regardless of where the stock is trading. So If all of a sudden the stock gaps down to 60 and you own the 90 put, you own the right to sell those shares at 90, even though they're trading for 60. So once again, using that analogy that it's like a stop limit order that never sleeps. All right, so now let's take a look at changes in implied volatility in puts and how they affect puts. I know we've done talks about implied volatility. I could talk this whole hour just on implied volatility. I know we've done some really great webinars just on implied volatility. But I'll give you a summary on implied volatility. But I always tell people this, that understanding implied volatility, it's one of the most misunderstood but crucial aspects of trading options. So if you really want to trade options well and profitably, which I know you all do, you need to have an understanding of implied volatility. So there's two types of volatility. There's historic volatility and there's implied volatility. So when we talk about historic volatility, we're looking at, it's a backward looking indicator. So we're looking at how volatile a stock has been in the past. So as you can see on this chart, the black line on that chart, this is how volatile the stock has been in the past. You can think of it as an EKG for your stock. So some stocks are more volatile than others. So a tech stock is going to be a lot more volatile than, say, a utility or a bank stock. So, every stock has its own personality, and they all trade at different volatilities. But just keep in mind, when we talk about historical volatility, we're looking at how volatile the stock has been in the past. Implied volatility only applies to options. So only options can have implied volatility. So the implied volatility is the market's forecast of how volatile that stock will be between now and the option's expiration. And the easiest way to think about implied volatility is when you hear the pundits on TV talking about implied volatility, that vol is high or vol is low or implied volatility is through the roof, all they're really referring to is the level of options prices. So when they're talking about implied volatility being high, you can infer that option prices are expensive. They're rather expensive. When implied volatility is low, option prices are inexpensive. So that's a real easy way to kind of think about implied volatility when they're speaking about it and you're hearing about it in the news. So implied volatility and its effect on options prices. So implied volatility affects options prices directly. So as implied volatility goes up, both the call and put prices will increase. And as implied volatility decreases, both call and put prices will decrease. Now remember, there's two types of volatility, historical volatility and implied volatility. So regardless of what a stock has done in the past, has no bearing on how volatile it'll be in the future. So you can get an idea of how volatile a stock has been in the past by looking at its chart, but it really tells you nothing about how volatile it'll be. You can get an idea of how volatile it would be going forward, but that's no guarantee. So, it's certainly, it's helpful to look at, but remember, it's just a backward-looking indicator where implied volatility is a forward-looking indicator. So now let's talk about volatility skew. So traditional pricing models assume that all options with the same expiration and underlier should have the same implied volatility, meaning that, the 10% out of the money call should be trading at the same volatility as the 10% out of the money put. And this is how options were priced for many, many years. And these days, we know that isn't true. We know that the downside is more expensive than the upside for most indexes and stocks, and there's a very good reason for that. So I don't know if everybody remembers this, but Black Monday, 1987, October 19th, the Dow Jones fell 22.6%, and the S&P 500 fell 20.4%. And when the crash happened on Black Monday, it really woke people up to the idea that option prices or options that stocks go down harder and faster than they go up. So there's an old saying in the market that the market tends to go up on a staircase and it goes down in an elevator. It's very, very true. So it might take months for a stock to go up 15 or 20%, and that same stock might fall 10% in one day. and this is true for stocks, this is true for indexes. So because of that, after the crash, it really woke up people to the fact that the markets tend to go down with more velocity than they go up. So because of that, the downside started getting priced a little more expensive than the upside. And that's what you see today. So these are the two types of volatility skew. So the chart you see on the left is how options were priced prior to 1987. So you can see the out-of-the-money calls and puts are trading at the same level volatility-wise. The chart on the right there, you see the skew that we see in most products these days, where the further down you go in strike, the more expensive those options get in terms of volatility. And then the further up you go in strike, it kind of levels off and it gets a little cheaper. So the downside in this case is a little more expensive than the upside. Now, does this exist in all products? No. So generally, most products, this relationship, the skew that you see on the right-hand side there, is what exists in most products. But there are certain products where the skew is actually backwards. So products like the VIX, where they trade options on the VIX. The VIX is it's a volatility index, and it measures the options, the level of options volatility on the S&P 500 options. There's a product where the skew will be backwards, where the upside calls will be more expensive than the downside puts. Another example, certain commodities sometimes trade at a reverse skew, where there's so much demand for the upside that the upside calls trade at a higher premium than the downside puts. I remember in the late 90s during the whole internet bubble, when everybody was trying to buy calls. They would buy calls at any price. And the call prices got so high relative to the puts, because investors, they would buy the calls and then they would sell the puts to help finance the value of those calls. And because of that, supply and demand relationship, the upside got very much skewed backwards. And, these days, many of those companies aren't even around anymore. But, in certain circumstances, that skew may be backwards. So here's that skew in a table. So we have a fictitious stock here. It's trading 125, and we have 7 days to go to expiration. And we can look at the 125, the at-the-money calls and puts. They have a fair value of 256, and they're trading at a 31 volatility. So as you can see, as you go down further to the 120 and the 115 strike, the volatility increases. It goes from 31 to 35. It goes from 35 to 41 on the downside. So those 15-level puts, even though they're trading roughly at 43 cents, or they have a fair value of 43 cents, they're trading at a 41 volatility. So in volatility terms, even though they're dollar cheap money-wise, they're expensive in terms of implied volatility. So we always say they're dollar cheap, but volatility expensive. So visually, you can see how these puts, the at-the-monies are trading at 31 vol, but the out-of-the-monies at the 115 level are trading 41. They're trading 10 vol points higher, so they're actually very expensive. You can look at the upside now. Look at the 130 and the 135s. Their volatilities actually go down. So they're 30 for the 130 calls and puts. They're 30 for the 29 for the 135 calls and puts. So you can see that natural skewness now, between the out-of-the-money calls versus the out-of-the-money puts. I mean, just look at the 125s, which are the at-the-monies. Look at the 130 and the 120s. They're both $5 out of the money, but the puts are trading 5 volatility points higher at 35 than the 130 calls. Okay, same with the 135s versus the 115s. Both options are 10 points out of the money, but the puts are trading 10 vol points higher than, actually 11 vol points higher, 12 vol points higher than the calls. The calls are trading at 29 vol, and the puts are trading 41. So you can see that natural skewness between the out-of-the-money calls versus the out-of-the-money puts. All right, so now let's look at some examples of protective puts. So the first example we're going to use is a very basic example. Stock is trading 65, and let's say we purchased those shares for 60. So currently we're sitting on a gain of about 8.3%, and we are looking to protect our gains. So, or we're looking to actually protect against if the stock rolls over. So we look at our options chain and we see that we can buy the 60 strike put 3 months out for $1. So the premium that we're going to pay is $100, because remember, every time we see an options price in the market, we have to multiply that price by 100 because there's 100 shares per contract. So an option trading for $1 is in fact going to cost us $100. So when we do that, put on this position, now we're long stock at 65, and we're long the 60 level put for $1. So here's the chart. Now, we always look at charts, whether they're P&L graphs or charts in this form, assuming this is expiration, because it keeps the P&L a lot cleaner, okay? So looking at this chart, we can see with the stock trading 60, we neither make money nor lose money on our stock, because that's what we bought it for. We paid $1 for the put, and that put would go out worthless if the stock finished at expiration at 60, so we would lose $1 or $100. Now, our break even with the stock trading 61, we make $1 on our stock, but we lose the $1 that we paid for the protective put. So we just break even. So anytime you need to figure your break even cost, you take the value of the put and you add it to the price at which you paid for the stock, and that gets you to your break even. So in this case, $61 is our break even price. Now, above 61, we start making money 1-to-1 on our shares. So if stock goes to 65, we would make $5 on our stock, and we would still lose the $1 that we paid for the put for a net profit of $4. So above 61, we make 1-for-1 on our shares. Now, if stock goes south, let's say stock goes to 50. Okay, well, at 50, we would lose $10 on our stock, but we would make $9 on our put, because at expiration, that put's worth $10. We paid $1 for it, so our net profit's $9. So as you can see, regardless of where the stock goes, we've locked in our loss at $1. Stock can go to 0, and the most we're going to lose on this position is simply $1. So here's that protective put example in graph form, because sometimes it's always easier to look at these in graph form. So that dotted green line is the stock itself. If we just own the stock, at 60, if it goes up, we make money. If it goes down, we lose money. Now, if we buy the stock with the protective put, you can see that our break even right at 61, that's where we break even at expiration. But above 61, we participate 1-for-1 on the upside. Stock goes to 100, we're going to participate all the way up to 100. On the downside, the most we can lose is the $1 that we paid for the put, or $100. So it doesn't matter where the stock goes in this particular example, the most we can lose is the premium that we paid, in this case, $1 or $100. So that is for a single stock. So now, how about a protective put for entire portfolio? So this is how I'm going to show you how to do this. So we have an investor who has a fictitious portfolio. It's a $100,000 portfolio, and it largely reflects a broad-based index or ETF. Maybe it mimics the S&P 500 or the Dow Jones Industrial Average. But this investor is looking to protect against a downside risk beyond a 10% correction. So in other words, they're willing to take $10,000 worth of losses, but below that, they want to be protected. So we're going to look to buy puts in a corresponding ETF whose performance mimics that of our portfolio. So once again, here's our $100,000 portfolio. We're looking for protection below 10%, so we're really looking to hedge $90,000 worth of risk. So, that the difference between 90,000 and 100,000, that could be considered our deductible. That's what we're willing to lose. But we want protection once it gets, down 10%. So we see that there's a corresponding ETF. It's trading 250, and we're looking to buy the 10% out of the money put. So we basically take 10% of 250, which is 25, subtract it from 250, that gets us to 225. So we're looking to target the 225 put. So we see 90 days out, the 225 put is trading for $3 or $300 per contract. So that's the put we're going to buy. So you ask yourself, well, okay, how many puts do I need to buy? Well, here's the formula. And once again, you don't need to write this down. You can if you want, but you can always download the PDF in the resources list tab at the bottom of your screen and have the entire deck. But this is how you would do it. So you basically take the portfolio dollar value of what you'd like to hedge, in this case, $90,000. We take the notational value of the strike, 225, and remember, every option is the right to buy or sell 100 shares, so we have to multiply 225 by 100. That gets us to 22,500. So we divide 90 by 22,500, we get 4 puts. So in this case, 4 puts will hedge $90,000 worth of our portfolio, and we will be perfectly hedged. So remember, each contract costs us $3 or $300, so we have to buy 4 of them. So this is going to cost us $1,200 for the premium for this type of insurance, or 1.2% of the value of our portfolio, our $100,000 portfolio. Now, you don't have to buy puts 1-to-1. You could buy 2 puts. You could buy 3 puts. In this case, we've chosen to buy 4 puts because we're just showing you how to hedge a portfolio perfectly. But know that depending on your outlook and risk tolerance, you don't have to, buy an exact number of puts to hedge the portfolio. And once again, you also have to assume a correlation of 1-to-1 between the portfolio and the hedge. So, it does you no good if you buy 4 puts in a biotech index if your portfolio mimics the S&P 500. So, once again, you want to pick an ETF or index that mimics the value or the beta of your portfolio. So here's that chart looking at our portfolio. So let's look at some examples at expiration. So if the index is trading 250 at expiration, in theory, our portfolio should neither make money nor lose money. We would lose the $1,200 that we paid for the puts, or 1.2% of the value of when we lose the $1,200 in put premium that we paid, which is 1.2% of the portfolio value. But if the index goes up by 10%, our portfolio should gain by 10%, or we should make $10,000 on our portfolio. We would lose $1,200 on our puts for a net profit of $8,800. So as you can see, we participate in the upside. Now the performance is going to, our percentage to the upside is going to be diminished by the premium that we paid for the put. So on the upside, our performance is going to be diminished by 1.2% because that was the value that we paid for the puts. So, but you can see on the upside, we get that upside participation, which is what we want. If the stock goes to 225, well, it goes exactly to our strike. Our put would theoretically be worthless, and we would lose the $1,200 in put premium. Plus, we would lose the $10,000 on our portfolio, also known as the deductible. So in this case, we would lose $11,200. But as you can see, if the market goes down by 30%, that's the most we're going to lose, the $11,200. So it doesn't matter where the market goes. We've limited our losses to $11,200 or 11.2%. So, well, you ask yourself, well, I really wanted to limit my losses to 10%. Well, you could have done that perfectly by maybe picking a higher strike put, maybe the 226 put or 227 put. But we're just using this example where, we're targeting the 10% out of the money put, but that put's going to cost us a little bid, which is the $1,200. So that's why the difference, the losses are 11.2% rather than 10%. But once again, if you want to tailor to exactly a 10% loss, you could maybe roll that your targeted put to a slightly higher strike. Okay, so now let's look at some alternatives. We're going to, we talked about buying the put outright. So what about some alternatives? So we've already established that those puts, because of the skewness in the options, are going to be somewhat expensive in terms of volatility. So what can we do to alleviate that, or make make the protection that we're looking to purchase a little cheaper? So we could put on what is known as a bear put spread. So now, instead of buying the put outright, we would be buying one put for protection and selling another put against it to lessen the cost of that protection. So it's similar to buying a long put in that the strike selection for your long put determines your exit price. The short put will determine where your protection is capped, but it will also, you'll take in some premium for that short put, and that'll lessen the cost of the overall trade. So also one thing to keep in mind is anytime you sell options, you are subjected to assignment risk. So theoretically, if somebody chose to exercise that put and you were assigned, you could be long stock for one day, but know that you have that higher strike put that you could exercise against it and alleviate that long stock position. But typically puts don't these days. Puts don't really get exercised early. There has to be an economic reason why somebody exercises an option early. So in the case of puts, the only reason somebody would really exercise a put early is if the short interest to be gained by being short the stock is greater than the time premium left in the option. So these days where interest rates are so low, there's not a lot of incentive for somebody to exercise puts early. So not that they couldn't be exercised early, anybody who's long those puts can choose to do whatever they want and exercise early if they choose. But there's not a lot of economic incentive to exercise puts early with interest rates being as low as they are. So here is our bear put spread example. So here we are long 300 shares from $95, and we're looking to put on the 90-80 put spread. And we see that we can buy that put spread for $2.60. So we have to buy 3 spreads because we have 300 shares. So each spread's going to cost us $260 for a total of outlay of $780. So with the stock at expiration trading 95 based on this table, you can see that we neither make money nor lose money on our stock. Our put spread would go out worthless. We would lose the premium that we paid on that, or $780. Now, if the stock goes up, once again, we participate on the upside, up beyond our break even. In this case, our break even would be the put premium that we paid, $260, plus the $95 that we paid for our shares. So $97.60 is our break even to the upside. So above $97.60, we start making 1-for-1 on our shares. So you can see with the stock trading 100, we make $1,500 on our stock. We lose the $780 that we paid for the put spread for a net P&L of $720. So, and we participate, if the stock goes to 110 or 120, we participate there. Our put spread would still go out worthless, but we get that upside participation. Now, if the shares go to 90, we would lose $1,500 on our stock. Our put spread would still go out worthless, but we would have a net loss of $2,280. Now, as you can see, between 90 and 80, because we have the 90-80 put spread, that loss that we have, the $2,280, that stays the same. That's the most we can lose on this position. So the only reason we would put on this position is if we thought that, obviously we want protection. We don't think the stock is going to make a move beyond probably 16 or 17%, but we want protection between 90 and 80. So in this case, we have limited protection, but as you can see, below 80, we start losing 1-for-1 on our shares again. So we have, no protection. If stock goes to 70, you can see that we lose 7,500 on our stock, and the put spread we're going to make 2,220 on our put spread for a net loss of 5,280. So below 80 is where that protection really ends, because we sold that 80 put short. So we just have limited protection between 90 and 80. But on the flip side, we have limited protection, but we didn't pay as much for those puts. So here is the chart of the bear put spread. So once again, the dotted green line is stock by itself, and the blue line shows where shows our 300 shares plus the bear put spread. So at 97.60, we break even. Above 97.60, we make 1-for-1 on our shares, and we have limited protection between 90 and 80. So our losses are limited between 90 and 80, but once again, below 80, you can see how that chart trails off, and we start losing 1-for-1 on our shares. So here is just a chart viewing the bear put spread versus the protective put. So once again, in terms of protection, okay, the bear put spread offers you more limited protection, but you pay less for it. So the bear put spread costs us $2.60. The put outright would cost us $5.35 a piece. So the bear put spread, or the puts by themselves, just buying the 90 puts outright, is nearly twice as much as doing the bear put spread. So, it's a risk versus reward kind of scenario. So in this case, the puts outright give us more protection because we get protection all the way down to 0. The bear put spread only affords us protection between 90 and 80. So the protection begins sooner with the bear put spread because we paid less for it, so $260 versus $535. The bear put spread is obviously less expensive than the puts outright. The break even is going to be lower for the bear put spread because our break even for the bear put spread is $97.60. Okay, the premium that we paid for the put spread plus the $95 that we paid for the stock. Whereas buying the puts outright versus stock, our break even is $100.35. So it's much higher with the puts outright. So the maximum loss is always going to be greater with the bear put spread because below 80 we lose that protection. Our maximum loss is going to be less with the puts outright because we get protection down to 0. And the profit potential is always going to be higher with the bear put spread because remember, when we buy puts in stock, the profit is really in the long stock or portfolio position. So it's going to be greater with the bear put spread because our break even is lower, $97.60 versus $100.35 for the puts outright. All right, so that is the bear put spread. So now we're going to look at something called a ratio spread, a put ratio spread. So don't let these terms throw you off. Anytime we talk about a ratio spread, all we're really referring to is when we buy more options than we sell or we sell more options than we buy. So a normal spread is done 1-to-1. We buy one call, we sell one against it. We buy one put, we sell one against it. That's a traditional spread. So a ratio spread is any time we buy or sell more contracts. So in this case, for one example, we buy 2 calls and we sell one against it. Or we could buy 2 puts and sell 3 against it. So anytime you're long more contracts than you're short, we call that being back spread. So traders, these are all floor terms that traders have been using. And when you're long more contracts than you're short, you're what's known as being back spread. When you're short more contracts than you're long, as in the example where you buy 2 puts and sell 3, if you're short more contracts than you're long, that's known as being front spread. So we're going to look at a long ratio spread, in other words, a put back spread. So in this case, maybe an investor sells 1 at the money put and buys 2 out of the money puts. In this case, selling a 60 level put and then buying 2 55 puts against it. So if we do this without the shares, we're doing this to participate on a huge move, binary move to the downside. Okay, so we're looking to profit from a big declining market. This is a bearish position. If we do a ratio put back spread with shares, we're simply looking to limit our losses from a large downside move with little to no cost. So we're looking to have that protection and not have this cost as much. And lastly, anytime we're long contracts, anytime we're long more contracts than we're short, we have a long vega position, meaning that implied volatility, if implied volatility goes up, that's going to help us. And if implied volatility goes down, that's going to hurt us. So here's the put back spread example by itself. So in this example, we are short one of the 90 puts, and we're long two of the 85 puts. And based on the prices we were able to do this, we did this for a 25-cent credit. So in other words, we got actually paid to put on this position. So our maximum profit, we have huge profit potential because if stock goes to zero, we're long an extra put. So on the downside, we participate immensely. But on the upside, the most we can make is the 25-cent credit. So as you can see here, even though we got paid a credit to put on this position, that's not to say we don't have losses. So if the stock goes right to our long strike, the 85 put, okay, well, our loss would be the difference between strike, in this case, $5, the difference between 90 and 85, less a credit that we took in. We took in a 25-cent credit. So our maximum loss would be $4.75 or $475 per contract. But it wouldn't cost us anything to put on this position, less any commissions. So, somebody would only do this if they're looking for a large move to the downside. And as you can see, we have two break-evens in this case. So the difference on the break-even on the upside would be $85 plus the $475 that we could lose. That's $89.75. And on the downside, it's 85 minus the 475, so it's 80 and a quarter. So on the downside, it's 80 and a quarter is our break even. On the upside, it's 89.75. So stock goes to 200, the put spread would go out worthless, and we keep the 25-cent credit we established it for. If the stock went to zero, well, we'd make out very well because we have that extra put and we participate below 80 and a quarter. But worst case scenario, stock just goes to 85 and sits. So we would do this if we were looking for a sharp downward move in the market in a specific time period. So maybe this could be an earnings report. This could be an FDA drug trial. It could be a legal case. All reasons why somebody might put on a ratio put spread. So now, what if we want to combine a ratio put spread with stock to hedge as a hedge? So here we have an investor who's long shares from 59, and they're looking to protect their downside at little to no cost without foregoing any upside potential. So these are the strategies. Well, we could buy a protective put, but that may not satisfy our cost requirements. So we've already determined that, due to that skewness, that those puts or the out-of-the-money puts tend to trade at a little higher level. They're a little more expensive. We can put on a collar, which is a trade where we purchase a downside put and we sell an out-of-the-money call to finance it. But in that case, we have the protection, but we've capped our upside. And maybe we don't want to cap our upside. We want upside participation. So the put-back spread actually checks off both of those boxes. So the put-back spread gives us upside potential on our shares, but provides protection against a big move to the downside. It doesn't protect against a moderate decline, but it protects against a big decline to the downside. So here's the setup. So we have our shares that we purchased for $59. And we look at our options chain and we see that we can sell the 59 put for roughly 66 cents. They're 65 bid at 68. And let's just say we could sell them a penny off the bid. So that's 66 cents. We buy two of the 58 puts for 33 cents a piece. So we have a debit of 66 cents. So we were able, in this case, to put on this put back spread for even money. Didn't cost us anything. So once again, for those who like to see how this looks from their delta position, if you were to calculate your deltas, this position would have a net long 93 deltas. So stock obviously has 100 delta. In this case, the put that you sold has a 51 delta. The 59 put has a 51 delta. That would be 51 positive deltas. And the 58 puts that we bought have 29 short deltas. So 58 minus 51 is a net short 7 deltas. So 100 plus minus 7 is 93. So this position overall would have what's known as 93 deltas, meaning that if the stock goes up by $1, we would make about 93 cents. If the stock went down by $1, we would lose about 93 cents. So let's take a look at this example in a table. So at expiration, if the stock is trading 58, okay, it goes right to our long strike. Well, we would lose $1 on our stock because we paid 59 for it. We would lose $1 on our 59 put because our 59 put would be worth $1, and our 58 puts would expire worthless. So you can see at 58, we would lose $2 or $200. But that's where the losses stop. Stock could go to 50. We're still only going to lose $2 on this position. Our break even, well, our break even is just where we bought the stock for, 59, because the spread didn't cost us anything. We were able to do it for even. So we have full participation in the upside. Stock goes to 60, we make $1. Stock goes to 62, we make $3. Stock goes to 64, we make $5. That put spread would go out worthless, and we have full participation to the upside 1-to-1. So in this case, we have achieved what we set out to do. So we get upside potential, earning potential, and we are protected to the downside if the stock made a big move to the downside. So here's that example in graph form. So once again, right at 59 is our break even. Above 59, we make 1-for-1 on our shares. And the worst case scenario, if the stock goes to 58, we lose $2, but that is the maximum that we can lose on this position is $2 or $200 in this case. So it's always easier sometimes to look at the P&L in graph form, but as you can see, in this case, we have hedged ourselves and it didn't really cost us anything. So once again, we used the skewness in the options to our advantage, where we were able to establish protection at no cost in this case. Not to say that we don't have a certain amount of losses. We do have some losses that we could take, but we've limited those losses, and we have put on that protection that we wanted to, while garnering the upside profit potential as well. So some things to know. So once again, buying puts gives the buyer the right, but not the obligation to sell shares at that particular strike price. Okay, and for that right, the buyer pays a premium. So once again, you can use the protective put strategy to protect an individual stock that maybe is a disproportionately large percentage of your net worth, or you can use puts to protect your portfolio as a whole. And once again, to keep that mindset of insurance, where the difference between the strike price that you pick and your stock price, that's your deductible, and then the premium that you pay for those options, that's the premium paid. So, once again, the cost of that insurance can also be lowered through using what we just examined with the bear put spread or a ratio put spread versus the protected put outright, because due to that natural skew in the options, those puts are generally going to be more expensive than the corresponding out-of-the-money calls. So now we can put on spreads and ratio spreads to help us offset that cost. Okay, that is our presentation. I know that Ed and Mark had been answering questions along the way. I know we have a little bit of time. Maybe we can answer some of these questions live. Before I answer a couple questions, I do want to mention, for more information, you can always reach out to us at optionseducation.org. Certainly make use of our investor education and investor services desk, which can be reached at options@theocc.com with any and all of your options-related questions. And you can check out our YouTube channel where we have archived many of our past webinars, just like the one you're listening to today. So if you want to learn more about any subject, whether it's historical, implied volatility, butterflies, covered calls, spreads, ratio spreads, we have done multiple videos on just about any subject you can think of. So certainly make use of that service. So let's see. Let's take a look at some of these questions. So let's see. Position management. So somebody asked the question, can you explain position management on the long put? Do I sell it at some point or hold on to it? Well, that's a good question. It's entirely up to you. So, maybe you're sitting on a stock. We'll use the example that we used earlier. Maybe you're sitting on a stock. You've owned it from 50 and now it's trading 100. They're long-term capital gains and you're looking to protect yourself. You could buy that put. Maybe you buy the 90 put and all of a sudden the stock rolls back over. Now, if you want to be out of the position come expiration, you could just do nothing and the put would just be automatically exercised. You would sell your shares and then you could just take that money and invest it elsewhere. Maybe you don't want to sell the shares. You could actually just, take your profits on the put. All of a sudden that put, stock's trading 60 now. You could choose to sell that put out rather than exercise it. Take the profits on the put, and you still own your shares. You could buy additional shares with the money that you made on the puts to dollar cost average your stock lower, or you could just take that cash and invest it elsewhere. So once again, either you can choose to exercise that put and have no position, or you can choose to sell that put and take your profits and deploy it within that stock or somewhere else. Or you could choose to roll the put as well. You could sell that put out, make some money, and maybe choose to buy a lower strike put and establish protection. And now you've done that at a credit because you took profits on your 90 put that put the stock trading 60, and now you could establish lower protection as well, and you'd still be making money. Let's see. If a put is at the money at expiration, do I need to take action or can I let it expire without doing anything? So you'll want to speak to your broker about this. So typically when a put is right at the money, let's say stock is trading 50 and you're long the 50 put and it closes right at 50. So we call that being pinned. And for people who are long options, it's the worst scenario because it means that the option is really worthless. But you would have to, in theory, if that option is right at strike, it would just expire worthless if the stock closed at 50. Now, if it closed if stock closed at 49.99, theoretically it would be a penny in the money. And from OCC's perspective, options that are a penny or more in the money get automatically exercised. You will want to speak with your broker directly about their policy because it may differ. But generally speaking, if the option is a penny or more in the money, it would be automatically exercised. So if you were up against something like that and you didn't want to exercise your option, you would have to file what is known as a contra exercise notice with your broker indicating that you're choosing not to exercise that option. So once again, check with your broker regarding their own internal policy, but that's what you would have to do. So let's see what else. Does it make sense to buy a protected put if the stock position is already down? Well, I mean that's a call that only the investor can really make. Once again, and nobody has a crystal ball. Obviously, if the stock went lower, in hindsight, you wish you bought the puts. But always keep in mind that that idea about implied volatility. So when the stock is already down, so the idea that stocks go down harder and faster than they go up. So when stocks go down, typically implied volatility or option prices gets more expensive. So just know that if a stock goes down 10% in one day or 20% in one day, those options for the most part are probably going to be very, very expensive. And buying those options when they're very expensive, you might be setting yourself up for further losses. So once again, you want to have a clear idea of the level of implied volatility that you're purchasing. Not to say it's the wrong strategy. You might still be able to purchase those puts and it may turn out to be the right thing. But just know that as stocks go down hard, the prices for those options goes through the roof generally. So you just have to be aware and be comfortable knowing what level of volatility that you're buying, and then you can make a decision on whether you want to buy those puts or do something else against it. Let's see what else. I think we can do one more question here. When trading option spreads, what determines if you are long or short? Okay, well, once again, when you're trading a spread of any kind, let's just say it's a 1-to-1 spread. Now, when you're long, let's just say stock's trading 100 and you buy the 90-80 put spread. Okay, you're buying an out-of-the-money put. Anytime you're long, in that case, when you pay a debit for the spread, in that case, because the 90 puts would be higher, more expensive than the 80 puts, you're paying a debit. We would say you're long the spread. Okay, just like if the stock were trading 100 and you were long the 100 calls and sold the 110s against it. Okay, you'd have to pay a debit to do that. We would say you're long the spread. So that's very different from being long or short the market. So you can be long a put spread, but you really want the market to go down. So your outlook is bearish. So or if you're long a call spread, your outlook is bullish. But when we talk about long or short with options, all we're really referring to is whether we are long the contract or short the contract. But if we're doing a spread 1-to-1 and we're long, in the case of calls, we're long the lower strike, short the higher strike, we would say we're long the spread. And in the case of puts, if we're long the higher strike, short the lower strike, we would say we're also long the spread. All right, I think we have one more question. What are the advantages to buying an in-the-money put? Well, the advantages are you get more and more protection. The in-the-money put is going to have a very high delta. So let's say stock is trading 100 and you buy the 150 puts. Well, the 150 puts are going to have $50 in intrinsic value, and they're pretty much going to give you 1-to-1 protection, depending on what delta those puts are trading for. So the downside is you don't really get any upside exposure on your stock. Okay, you're buying your stock has 100 delta. The put that you buy has 100 delta. So it's kind of a wash. So if you buy an in the money put, depending on how far in the money it is, you would be foregoing more upside, but at the same time, you're protecting yourself more to the downside. So it really depends on what delta this gets down to the conversation about delta. So, I know we don't have time to talk about the Greeks. We've done webinars on the Greeks. And if you don't understand delta, please watch some of those webinars. But in this case, it's the delta of the put is going to determine how much protection you have. So if you're long stock, it's 100 delta, you buy 70 delta put, you're going to be net long 30 deltas. So you get upside exposure to an extent, but it's limited by that deep in the money put. So, once again, everybody's different. Everybody has individual risk tolerances and outlooks on particular shares, and it's going to differ for one person to the next. So, once again, there's no right or wrong answer, but just know that those protective puts, that generally speaking, people buy out of the money puts, at the money and out of the money puts, and just know that those puts tend to be a little more expensive just because of the skewness in those options, and you really want to know what you're buying. So, one of the smartest guys that I ever traded with said that price is everything, and it is the truth. Price will make you and price will break you. So depending on the price that you pay for your options really somewhat will dictate how profitable you'll be on that position. So just something to keep in mind. So anyway, I appreciate everybody's time today. I know we're out of time, but if it's not too much trouble, if you can fill out the survey at the end of the presentation, we certainly look at each and every one of your comments, and it helps shape our program going forward. If for whatever reason we didn't get to one of your questions today, somebody on our investor services desk will reach out to you sometime tomorrow with an answer to your question. And have a great afternoon, and we look forward to seeing you July 14th, where Ed Motley will be giving a webinar on the option collar. Thank you very much, everyone. Bye-bye.